David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello, clients and friends. Welcome to the second of what will be a series of podcasts that we will host on an ongoing basis. For the time being, the goal is to produce these podcasts on a weekly basis as the COVID-19 situation remains fluid. Ultimately, we will produce them on a monthly basis. Through these podcasts, we continue our observation of the economic impact of the response to the virus, and we'll continue to share our thoughts on current market conditions, as well as the opinions of many of the economists and analysts and managers that we follow on a routine basis. Now, please feel free to share the link to these podcasts with anyone that you may feel would also benefit from having the information that we're disseminating through this channel. Okay, let's begin just with a brief market overview. Now, this data was current as of the close of business on Wednesday, the 22nd of April. Just a brief reminder, the intraday low for the Dow Jones Industrial Average occurred on the 23rd of March. With a value of 18,213 points. Now, again, only time will tell if that proves to be the low for this event. The previous market high was established on the 10th of February with a value of 29,379 points. From that high water mark to the most recent intraday low on the 23rd of March, the Dow Jones Industrial Average was down by 38%. So as we've discussed, clearly the reaction to the virus was very sharp. Now, since that low point, the market is higher by 5,263 points for a gain of 28.89%. With yesterday's closing value of 23,476 points, we remain off that recent high level by 5,903 points, or 20.09%, so right at 20%. Many of you have asked, especially this week, about oil, because we've clearly seen some strange things out of the oil complex this week. This morning, looking at the website for the CME Group on Thursday morning, the 23rd, we see that the June contract is currently trading at $16.63 per barrel. The July contract is trading at $22.51 per barrel, and the August contract is trading at $25.24 per barrel. Now, looking at even further, we see that the December contract is trading at $29.91 per barrel, and the March 2021 contract is trading at $31.73 per barrel. It seems odd, doesn't it? Just 72 hours ago, the May contract settled at negative $37.20. Is that really telling us that you can't give oil away for May delivery? And indeed, that you must pay someone $37.20 per barrel to sell one May delivery contract? Technically, no. There is demand for oil. The problem is that we have too much of it in the global supply right now. Remember, the Saudis launched a price war earlier in the month and began to produce at maximum capacity for a short period of time. Now, we knew that a coming economic contraction was on the horizon as a result of shutting the economy down in an effort to flatten the COVID-19 curve. Demand is projected to be much lower than in previous months for May as a result, but there is demand. We have a large, short-term imbalance between current demand and current supply. On the day of contract settlement, if you're a speculator or a hedger, you must decide whether to hold your contract and thus exercise it for physical delivery in May, or sell the contract. We have sharply lower demand in May, plenty of supply on the global market, and very little capacity for storing oil right now. The Cushing, Oklahoma transfer facility is at near capacity, and reports suggest that the U.S. Strategic Reserve is near full capacity. So when faced with the decision to sell the contract when there is no market for the contract, or take delivery when you have no room for storage, it will create the strange result that we saw on Monday, when futures contracts traded in negative territory for the first time in history. Now, yesterday, according to Brian Westbury, he's the chief economist at First Trust. We listened to his podcast that he held yesterday on Wednesday. Another problem that arose on Monday was Y2K in nature. What do I mean by that? The trading systems rejected trades with negative price points. They were never programmed to recognize negative trade values because, well, it's never happened before. So at about 2 p.m. Central Time, we experienced a large insolvency issue where sellers could not sell and buyers could not buy because the system would not accept the trades. And that created a negative snowball effect. Now, given the fact that on the following Tuesday, we saw the May contract rebound from negative $37.20 to a positive $14.10 in 24 hours, seems to confirm that Monday was, yes, a supply and demand issue, but it was exacerbated by technical issues as well. It is interesting to see how prices of oil in the future are trading, however. So look, if the May contract was historically weak in anticipation of a sharp reduction in demand resulting from economic contraction, then does the fact that the December delivery trading around $30 a barrel tell us that the energy complex is anticipating the economic recovery in the fourth quarter that we're hearing so much about? Quite possibly. We'll keep our eyes on that. Legislatively, this is being called the CARES 3.5 Act. As we're recording this podcast, the Senate has approved a $484 billion second wave of funding for the provisions of the CARES Act, and it is expected that the House will vote to approve the measure as well. Now, this puts an additional $310 billion into the Paycheck Protection Plan to continue funding that program. Now, this is of critical importance because this funding provides employers with the ability to retain employees and pay the employees and thus benefit from the retained employee credit of the CARES Act, and also gives them the opportunity to furlough with pay, preserving their workforce and leaving health care benefits intact for millions of employees. It is this funding measure that can help maintain the consumption momentum from earlier in the year and span this gap created by efforts to flatten the COVID-19 curve. On the subject of reopening the economy, as we've discussed before, I believe that we have seen the apex of COVID-19 in this country. Now, each state is observing their own curves, but on the whole, I believe that the data confirms that we are on the downside slope of this bell curve. We have not seen the apex of bad economic information, however, and we'll likely see that apex of bad economic news over the next 30 days. Now, you've heard me suggest many times over the last few weeks that, in my opinion, we would have the last of the historically bad weekly jobless claims reports today. And we did. We got another number that was around 4.4 million. That's well off last week's number. But here's my Pelican brief. Starting next Thursday, 1 week from today, my guess is that we will begin to see those claims for first-time benefits begin to decline, and possibly sharply. Now, the reason for that belief is because the CARES Act was only passed into law at the end of March, and the Payroll Protection Plan went live a little over 2 weeks ago. Some banks were not able to participate right away. Therefore, the first $350 billion of the PPP money has only begun to be received by the employers who wish to retain their workforce. That's something that's occurring now as we speak. As the second tranche is filled and applications in the queue are approved, then we will see the continued flow of another $310 billion to those employers. Therefore, it will only be by next Thursday that we will first be truly able to measure the impact of this program in the form of lower layoff figures. Also, I believe that workers that had been previously laid off will be recategorized as being furloughed with pay, and that may result in positive revisions to the previously historically bad reports. Now, the Labor Department report that we receive on the 8th of May will likely be the worst that we see in the COVID-19 crisis. Why? Well, look, that report covers the survey period from the 12th of March through the 12th of April. Now, it was during this time when we saw most of the efforts to close restaurants and were businesses that were deemed to be non-essential. And it also included the period of time prior to the passage of the CARES Act and thus before the Payroll Protection Plan, when employers were faced with few other options than to simply lay off employees. We may very well see an unemployment rate of negative 13% or higher, with payroll losses of 2.5 million or more. So look, just be ready for that. Furthermore, don't be surprised if the market is higher on that day and seems to shrug the number off. Remember, I've been saying this now for weeks. The markets are discounting mechanisms. The markets have already priced this number into themselves. Conversely, I believe that the Labor Department report that we receive on the 5th of June for the reporting period that covers the 12th of April through the 12th of May could be starkly positive and also carry with it sharply positive revisions, because this will reflect the period of time following the passage of the CARES Act and the cumulative $660 billion of money that will have been received by small business employers at that time to retain members of their workforce. So just be ready for that. Over the next 30 to 45 days, we will likely see some very starkly different, ugly, and much more positive looking economic numbers. All right, on the COVID-19 update, look, I'm not going to rehash all of the data that we've discussed in previous months on this subject, but I will say this. As of Thursday, the 23rd of April, we have had 849,094 reported cases of COVID-19 in the U.S., and of those cases, 717,360 remain open. And again, this includes people that have been tested over the last 14 days. We know what the numbers of recoveries look like as you emerge from that window of time. So several weeks ago, remember I suggested that we would likely see a strong upsurge in recoveries? All right, well again, citing not only Worldometers but also the World Health Organization and the CDC, it appears that the recovery rate is over 96% for those not in a high-risk group. And it is interesting to note that 3 weeks ago yesterday, on Wednesday, we had 37 recoveries in the United States. Today, that number stands at 84,050. You do the math. The slope to that line is nearly vertical, and it's the strongest of any of the COVID-19 trend lines on the Worldometer site. That is a very positive development. So look, given the recent trends of the virus and the improving numbers that the president cited yesterday, and the degree by which social distancing seems to have flattened the curve, the administration seems comfortable with moving forward with a progressive plan to reopen the economy in stages. Now, the markets have been moving higher since the 24th of March, in part because worst-case assumptions that were priced into the cathartic reaction to the disease in February may not be proving to be the results that we're observing. So again, if you've watched the news, you know that the initial models from the University of Washington and others, the very models that we relied upon to shut down the economy, have been dramatically revised downward in recent weeks. As we've discussed within conference calls, again, markets are discounting mechanisms in both directions. Now, the markets are in the process of repricing the assumptions made 2 months ago in light of currently available information. Now, lastly on this topic, and I think this is important, this week alone we have seen studies from Stanford, USC, and Massachusetts, and they seemingly have come to similar conclusions. They're suggesting that the actual rates of infection could possibly be 50% higher than we have observed through testing, given the number of asymptomatic people tested in random samples that tested positive for antibodies. The conclusion being that herd immunity could be vastly higher than any model anticipated, and that's a really good thing. So in conclusion, look, just the affirmation of what we're doing here. We've got to stay focused on where we're going. As we've talked about in previous calls, every one of you has a financial plan behind the strategy that we're following, an objective that we've defined, and a strategy that we created for the achievement of that objective. You can't react to a shocked market. If you try to do so, it historically creates a larger problem of having to battle the emotional aspects of when to return to the market. If your objectives remain in the intermediate to distant future, make this crisis work for you. Lastly, we're having Zoom video meetings, inter-call conference call meetings, as well as individual phone meetings and these podcasts while we remain unable to have face-to-face meetings. I really hope that changes in the near future. In the meantime, while we're trying to stay in contact with each of you, please never hesitate to reach out to us with your questions and needs of clarity. This podcast, virtual meeting technology, social media, and other channels are just part of a multifaceted approach that we've adopted as an effort to lead in this crisis in a visible manner. We'll get through this, guys, and we'll get through it together. Of that much I can assure you. Thank you for your time, and we will have another podcast next week.
David Guttery and Brandon Guttery offer products and services using the following business names: Ameritas Investment Company, LLC, AIC, member FINRA, SIPC for securities and investments. Ameritas Advisory Services, AAS, for investment advisory services. AIC and AAS are not affiliated with Keystone Financial Group. Products and services are limited to residents of states where the representatives are registered. This is not an offer of securities in any jurisdiction, nor is it specifically directed to a resident of any jurisdiction. As with any security, request a prospectus from your representative. Read it carefully before you invest or send money. A representative will contact you to provide requested information. Representatives of AIC and AAS do not provide tax or legal advice. Please consult your tax advisor or attorney regarding your specific situation.